good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at yet another round of earnings, and we're looking at the banking sector today, specifically those Canadian-owned giants in the form of Scotiabank Trinidad and Tobago, as well as FirstCaribbean International Bank, or CIBC FCIB. Now, both groups would have reported some varying fortunes in terms of their results. Let's take a look at how they would have done and what investors might expect in the coming months ahead. Turning firstly to FirstCaribbean International, or FCI, well, the group would have reported an earnings per share figure of 60 cents TT dollar equivalent, as almost 70% increase from the 36 cents per share TT equivalent recorded in the prior comparable period, and that is fiscal 2022 versus fiscal 2023. Driving this performance was a very commendable improvement in total revenues, up just about 29% from 1.9 billion TT equivalent to just under that $2.5 billion level. Operating expenses also increased, but by a less than proportionate amount, from 1.29 to just about 1.4 billion TT equivalent. Overall, net income attributable to equity holders increasing a whopping 69.4% from 560 million TT equivalent to just under 950 million TT dollar equivalent. Now, again, the revenue story looks pretty good for FirstCaribbean International, or FCI, over the past couple comparable periods, and in the most recently concluded period, again, that 28.9% increase in revenues generated, of course, coming on the heels of an almost 42% increase in net interest income, moving from 1.224 billion TT equivalent to just about 1.748 billion, of course, and driven as well by a modest increase in operating income from other operating income, rather, from 684 million to just about 711 million, so a roughly 4% increase there. Overall, from a profit before tax by segment, again, it makes for good reading for FCI shareholders, where the corporate and investment banking segment, traditionally the largest segment, would have improved in terms of profit before taxes by about 20%, from 696 to 837 million TT equivalent. And the other notable increase would have come in the retail business and international banking segment, which moved from 33 million to just about 107 million, the equivalent of about a 225% odd increase over the comparable periods. Now, in terms of value and relative valuation, FCI still remains, despite those increases in its earnings as well as its increases in its stock price on a year-to-date basis, it still remains one of the most relatively cheaply valued stocks on a price-to-earnings basis, trading at about 7.3 times, compared on the other end of the spectrum to Scotiabank, for example, which is trading at a 20 times price earnings ratio, and the sector average in general, which is about 12.8 times. So dollar for dollar, in terms of earnings generated, investors will be paying the least or the lowest amount for FCI's earnings that it generates. So at the trading price of $7.01, FCI is trading at that price earnings ratio of 7.3 times, below that sector average of 12.8 times, and offers a fairly attractive dividend yield of 4.3% compared to the sector average of 3.2%. So with that promising revenue growth in mind, those relatively attractive valuations, as well as its dividends being paid in US dollars, Bourse is going to maintain an overweight rating on FCI for the time being. Turning very quickly to Scotiabank Trinidad and Tobago, or SBTT, for their half-year period, they would have reported a modest decline in earnings per share, falling 3.5% from $2.02 in the prior comparable period to $1.95 in the most recently concluded period. Net interest income actually increased 16.4% from 596 to 694. There was an offsetting or partially offsetting decline in other income, which led to overall total revenues improving by just about 2.3% from 952 million to 974 million. Overall income after tax would have declined from 356 million to just about 344 million, that 3.5% decline. When we take a look at Scotia's revenue trajectory, again, positive, but there have been some changes in that most recently concluded period. Again, other income falling around 20% from 356 million to just about 280 million, with net interest income, of course, improving that 16.6% from 596 million to 695 million. Leading to that overall revenue gain. One of the positive drivers for Scotia, which has helped to bolster investor confidence in the stock and the stock price, has been that trend of increasing dividends. And we can see since that very COVID-affected year back in 2020, we can see that in that sort of let's call it a pinkish salmonish color. We see that total dividends on a trailing basis have, or for the half-year period rather, would have increased continuously from $1 to its current level of $1.40 based on Scotia's recent declaration of their interim dividend, and that payout ratio has been maintained as relatively robust at around that 65 to 70% region. So again, as mentioned, Scotia is trading on a relative value basis at the higher end of the price earnings spectrum, about 20 times relative to that 12.8 banking sector average time, but it is offering investors a fairly healthy and often predictable dividend yield, currently at 4.5%, again, compared to that 3.2% sector average. So with those improved revenues in mind, keeping an eye on those high expenses, but of course, bearing in mind, of course, those consistent dividend payments offset to some degree by those elevated valuations, Bourse is going to maintain a market weight rating on Scotia for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 2BORSE or 226-8773. Email us at invest@boursefinancial.com. And of course, you can check out all of our research, which is absolutely free on our website, bourseinvestment.com. Stay safe, stay dry, enjoy the Father's Day and the long weekend, and we'll see you next time on the Bourse Report.